Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, keep your hands to yourself, David. No hands on the hips. Creighton came that close to making the Final Four. A little touch foul at the end, but quite a run by the Blue
Yeah,
Jays.
and I gotta admit, I like the way the coaches and the players all handled it. Hey, look, we didn't lose because of that single entity, or that single foul, but, it was awfully close, and that was a little frustrating, that little ticky-tack hand on the hip, if you will, but, they had a great run, they've made it farther than they've ever made, and I think they've, Coach McDermott has set a foundation now, so I think we can expect good things going forward, and, the cool thing is the Final Four this weekend is got a lot of unfamiliar faces. So to me, that makes it exciting to watch. It's not old familiars. We're not watching Kentucky or Duke or what have you or Kansas.
Yeah, none of the number
You know,
one seeds, or
yeah,
even two or threes, I don't think made it.
yeah. This
Yeah, so
the
it's really
yeah,
something.
fours and up only. So anyway, pretty cool. And
March Madness.
but it's always
Yeah.
fun. Tournament basketball, you got to show up, right?
Yeah,
So
yeah. Well done, Blue Jays. Nice run. Meanwhile, Dave, another big week here at Retire Smart. We had the Smart Protection Insurance classes going on. We had the ABCs of Medicare, and every time I walked by the room, it was full, David. These workshops are really cooking.
yeah, and a lot of our clients take advantage of the education, and that's part of our, kind of our promise to our clients is financial planning is an ongoing thing. It's not go get a 120-page plan some of these places will put out and puts in a 4-inch binder and sits and collects dust on the back shelf in your home office. The financial planning is a living, breathing way of looking at your finances, continually addressing issues that may come up. And let's face it, at different phases of life, different issues are going to come up. Taxation, income planning, Medicare planning, just understanding your homeowner's insurance, which was that the smart insurance class has become really rave reviews, and just that was usually chock full of most of our clients just learning how their own homeowners insurance, how their auto insurance works. So it's really cool because just in the last 2 weeks, we've had over 200 people attend these classes and get some education. And these are complimentary for our clients, and of course, we offer them to our radio listeners if they want to take part as well.
No
and just get
charge, no
educated.
obligation. Just come and just call us first. So stay tuned, week after week as we come up on the next round of workshops. We'll let you know. In the meantime, David, on to the news. Uh, okay, the Fox Business headline says Inflation Reduction Act to cost U.S. $1.2 trillion. That's according to a study by Goldman Sachs. Um, David, that's about 3 times more expensive than proposed. The Inflation Reduction Act that was going to get our fiscal policy under control. Oh, my goodness.
Yeah, it's been a joke, and I think everybody, even those that lean to the left economists, have realized how they've got egg on their face because even promoting it with that language, Inflation Reduction Act, when it's just creating additional inflation as we're seeing. But here's the thing: is it was supposed to at least raise some revenue, and so the net cost was only supposed to be about $350 billion of the $1.2 billion we spent. In other words, we were supposed to start getting new revenue, but according to Goldman Sachs analysis, that's just hogwash. We're blowing the whole $1.2 trillion. It's a negative net revenue gather, and we have higher inflation. So, does that do anybody any good? Well, it does a couple of fat cats at certain companies that were benefiting from where these dollars flowed for sure. And of course, we're not here to pick apart Congress people, but there are lots of Twitter accounts now that follow some of the stock trades some of these Congress people make, which is I think is still a problem. And there's been proposals
We've talked about that numerous
to
times.
stop
Yeah.
that nonsense. But anyway, people should be upset. Your government is not helping you in this environment. They're not helping the lowest economic indicated people, the lower income earners, the lower asset level folks. They're not helping the higher level ones. They're really doing damage to the economy. And if it goes on much longer, it's going to get really, really severe.
David, you sent me a chart. And by the way, listeners, we are out there on YouTube now. If you go to YouTube and search for Retire Smart, you can actually see us as well as hear us, which would be an advantage here. We'll have this chart as part of our video on YouTube. But David, you sent me a chart from the Cato Institute, and it's regarding the so-called Biden's billionaire tax. I see total federal taxes. I see individual income taxes. What am I looking at? What is my takeaway from this chart, David?
Well, it's telling you who pays the tax, right? So this idea that this populist notion that AOCs in the world, we're going to tax the rich. Well, who do you think is paying the tax
It's
bill?
already happening.
It absolutely is happening, and the rich are ponying up. And again, listen, yeah, billionaires have billions of dollars. That's great for them, but in most cases, this wasn't just handed down to them. They grinded and worked and started a business and invested their capital. And again, you have to risk all your own capital when you start a business. Believe me, I know. I've started several and not all successful. And when you lose money, the government doesn't come help you there. And so, the idea behind this idea that we should tax the rich, they're getting away with all this extra money. This chart kind of lays it out for you graphically so you can show who pays what tax. And the top 1% are paying about 23% of all taxes. That's just the top 1%, right?
That actually says
Or 0.1%, excuse
That's
me.
a tenth
Yeah,
of 1%.
yeah, tenth
Yeah.
of 1% are paying
Yeah.
23% of all taxes. That's your true billionaires. And just so you know, there's less than 1,000 of them in the U.S. So you're talking about 850 or so taxpayers that are paying that bill. And again, Elon Musk, I think it was 2 years ago, he paid the highest tax bill anyone in history has ever paid. And he kind of put that out there when people are saying, oh, he should pay more. Well, how much do you understand? Every dollar you take from someone like that, those folks don't spend their dollars. They reinvest that capital.
It's money you're taking out of the economy.
Correct. They invest it and create jobs. I mean, I did it right here. I've talked about it. I went back and tracked, and this is by my own math, but we have 33 or 34 employees. I don't know how many employees we have right now. A big org chart, right? We've grown fast, but 14 of those jobs came directly from Trump's tax cut. In other words, I took what I saved from the Trump tax cuts in 2018, literally poured it back into marketing dollars for my company to grow the company, and that money kept scaling and growing. And I attribute 14 of my full-time employees were attributed to that tax cut to incentivize a business owner, an entrepreneur like myself, to invest in my local economy. And this chart just proves it for you. And but the people at the bottom, like, oh, we shouldn't have to pay taxes. Well,
They aren't.
they don't. You're exactly right. You've got to get until you're above the 40 percentile before you pay any tax in America, any at all. So the bottom 40% of income earners don't pay $1 in federal income taxes, not $1. Now, I would argue that's not a fair system. And again, we've got these crazy systems of extra credits for this and that and deductions and all kinds of crazy incentives in the tax code. This is why no matter where you are on that income threshold, wherever you are in the asset land, you've got to get professional help to navigate the tax system. The tax code, and we talk about this in the tax classes and the dinners that we do, Chip, all the time. The tax code is actually written to help you lower your tax bill. So why get mad at somebody who's simply following the law and doing what the incentives are laid out? Yell at Congress for making the system that way. If you want to make it easy, just do a fair tax. I'd be all for that. I don't think it's coming, but I'd be all for it because that is the fairest and most equitable way to distribute taxes and let everybody have equal opportunity, not equal outcomes.
Well, David, every once in a while we get a story out of California, and this headline is from the Associated Press. California may punish oil companies for high gas prices. David, correct me if I'm wrong, but it's not the oil companies who are driving up the prices right now, but they're being made the scapegoats.
Absolutely, because it's good political rhetoric to go out there and blame them. Listen, the oil companies sell oil at the market rate, right? The market sets the price. And then distribution companies grab it and transport it, right? So oil, transportation companies will buy oil and then deliver it to like local stations, et cetera. And then the station, which is local, usually a local entrepreneur, a mom and pop operator, just the kind of person we're talking about, they have to make a margin on that. They have to mark up the gas to pay for the facilities, to pay for all the regulation, pay for the safety of their tanks. And there's tons of it. And I mean, I had a client years ago that owned a gas station in Georgia. And I remember when gas back then was about $1.15 a gallon, and he was complaining he could barely make 8 cents a gallon. He's like, if I can't make 10 cents a gallon, I don't want to sell gas, right? And so people don't understand the margin is pretty thin, right? And so it's not like these companies just set the price at the gas station. Your local Chevron or Sunoco or Exxon, wherever you go, that's a franchisee buying a local gas station, and they are just affiliating with one of these large oil companies for the distribution of the product. And on top of that, California, it's a joke, has one of the highest gas taxes in the country. So they're a part of this, and they want to add more to it. And they want to penalize these gas companies. They're just going to say, no thanks. We'll take it elsewhere. Then you find out how supply and demand really works. If you only had maybe 20% of the oil flowing into California, What do you think it's going to cost the drivers then?
Oh, yeah, and yeah, that's another point, a good point you make, that how much of that gas price is built in by government, by taxes, fees, and so forth, and then, of course, inflation, what that's been doing to everyone, all the inputs,
In
in
several
that
states, it's
industry.
over 60 cents a gallon is taxation, federal
I believe
and
it.
local,
Yeah,
and so
mhm.
think about that when you're paying about $3 a gallon, over 25% of that bill is taxation. It's not the product you're buying. And gas is one of those products that they embedded in there. So, because imagine if they got to advertise the price, hey, it's 2.29, and then you go to pay and it was 3.10 a gallon. Wait a minute, what happened, right? And so people sometimes forget to understand just how much taxation is put into that, and that's where we get a lot of taxes. People don't realize, according to the American Heritage Foundation, the average American pays over 60 different types of taxes in a given year. And of course, gas taxes are one of them, or a couple of them.
We got about 30 seconds to squeeze this in, David. Hi ho, it's home from work week, ho. The Magic Kingdom's feeling some pain, David. Disney layoffs will begin this week, CEO Bob Iger says in a memo. This was in CNBC. Well, I guess if you keep picking fights with the governor and you alienate your customer base, eventually it's going to catch up with you.
Listen, I can tell you, somebody who lived outside of Disney's doors for a very long time, they are hugely important to that local Central Florida economy, no doubt. But they are not the single point of contact they once were. Have Universal Studios, SeaWorld, Busch Gardens. You have all these amazing attractions, the cruise lines out of the Port Canaveral, which I used to live real close to. So there's a lot of other options for Florida tourists to go spend their dollars. And you're right, Disney went in a different direction. Now they did bring back a good CEO. I do like Bob Iger. He's a pretty decent CEO. But the problem is the direction they've been kind of scaling to for the last decade or so. I can tell you, my own family has season ticket holders to Disney and all the cousin stuff. And my wife's always yelling at me. I was like, I don't really want to go to Disney. I'm not, I mean, I haven't been
Hmm.
since I took my kids when they were much younger. Not a big Disney fan. And they've all left and they were Disney addicts. And now they have the passes now to like Universal Studios and what have you instead, because they're just not happy with the product that's being delivered. It's not the same experience.
Well, another round of major layoffs in the economy. Where's tax policy going to go? Keep track of it, but don't panic. Come see us for a report card, 402 369 7777. There's no charge, no obligation. It's a comprehensive review of your financial situation. Maybe you're in good shape. Maybe you need to make some changes. Now's the time to find out. 402 369 7777 for the complimentary report card. 402 369 7777. Up next, the banking industry hasn't wobbled like this since 2008. We'll explore the crisis in detail and what it means for you next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David, I love bringing in your comments from our weekly team meetings to the show because I want everybody to get the intel that you give us during the team meeting. And you said at our last one, you were talking about the Biden administration saying, well, we've got a buyer for Silicon Valley Bank and all is fine in the banking industry. And your comment was, you're not a bear by nature. You're an optimist by nature, but you said this is as bearish as I've ever been in my career, and there is more carnage. I wrote it down. That was your
Yeah.
word. There is carnage to come. David, sort it out for us.
Absolutely. This nonsense, then you got yelling out there kind of talking about, hey, we can stop all the banks if we need to, backstop them all. And that's just not true. Where are they going to get the money, Chip? They're under, these balance sheets are not good, and some of the largest banks are really not looking too good and too rosy, and they're trying to kind of smooth the ride out. But the reference that I think I gave it in that team meeting was, if you just go back 2008, Bear Stearns disappeared, huge investment house, in March, I believe, of 2008. And we were in September, about 6 months later or so, and Lehman Brothers was the next domino to fall and about to go under. And to calm everybody down, a facilitated transaction was set up, much like SVB just got bought by another smaller regional bank. That was a handshake marriage made by basically Treasury Secretary going, hey, you're buying these or we're going to shut you down. And,
Yeah.
and that's what happened. And so J.P. Morgan purchased Lehman Brothers for basically $2 a share on September 15th, 2008. Well, if you go forward to October, November, December, January, February, March 9th, so just shy of 6 months later, about a week shy of 6 months later, the S&P was basically, which was 1,192 points on the S&P on September 15th. I believe it was 667 on March 9th. That's a pretty big drop, right? Because here's the reality. If these banks are having to tighten the credit standards because they have less deposits, and we're having hundreds of billions of dollars leave every week of these banks because people are nervous, and rightly so. So if they have less reserves, that means they can make less loans, right? Less loans means less profitability. And this is the domino effect that I see coming. The carnage that I reference is you're going to see earnings really start to ratchet down in the next 2 quarters, at least in my humble opinion. And that will not spell very good things for the price of equities on the broader market.
Well, now that seems to be what's reflected in this CNBC headline that the public does not seem to share the government's confidence. The headline is nearly 100 billion in deposits pulled from banks. Officials call systems sound and resilient. That's not how the people seem to be
No,
reacting.
and we've had several clients express concern and call us, and we've kind of explained to them, listen, no one's ever lost a dollar on the FDIC insurance rule. And so as long as you're under the $250,000, we don't want anybody panicking. But if you are over that, if you do keep, four, 500, 600, $800,000 in savings and CDs, and you're nervous about that, you can give us a call. We can explain to you how the rules work. It's by Social Security number, but so Chip, if you and I were hypothetically married, you could have an account for 250,000 at the same bank that I could have an account with, and then we could also have a joint account. So we could protect as a married couple $750,000. So we just want people to understand how the rules really work. And you could go to different institutions, but you can also find a way to probably earn a little bit better interest rate. These banks are under a lot of tremendous pressure, and so some of them are buying deposits. So if you're seeing 5.5% deposit rates, there some teaser banks offering this for you to go put money in them. They're buying deposits, Chip, because the money is flowing out the back door so fast. They need deposits, and they won't give those rates very long. But if that makes you nervous, there are alternatives. We have alternatives available that we can help you. One of the things is we have a simple treasury management program where we can put dollars into very short-term duration U.S. government T-bills, treasury bills. They can mature in 4 weeks, 8 weeks, 13 weeks, et cetera. And right now, they're grossing over 4.5%. And you don't have to pay state income tax on that, by the way. So, but anyway, if that's something that concerns you, we'd be happy to help people out with it.
Those kinds of transactions don't concern me or make me nervous. I'm still reeling a little bit from the same-sex marriage reference, but we'll press on. The name actually, speaking of that, Barney Frank comes up next. And his name has come up before in this round of news stories. Well, first of all, here's the headline from the New York Post: Barney Frank under fire over role on board of doomed Signature Bank. This is another big bank that went down. I think we need to back up, David. Who is Barney Frank? What is the Dodd-Frank legislation that's been referenced in many of these news stories? And why does Barney Frank look so bad right now?
So coming out of the carnage that was the Great Depression, if we went through here, Great Recession back in 08, 09, right? Legislation was put forth, and this was basically by Chris Dodd and Barney Frank, two now retired senators, both on the left
Frank
side
was
of
in the
aisle.
House, I think.
Yeah,
but
Frank,
Dodd was the senator.
But they were the ones that kind of co-sponsored the legislation in each house, correct? And the House of Representatives. And so what this was a gigantic overreach, and it was meant to placate the public. Hey, we're going to take care of this. This was a 2,300-page gorilla of a bill that created over 400 new regulations and compliance reasons and things that banks had to do. Now, the House Services Financial Committee, which was run by Democrats, did a study on this just 2 years ago when they were in charge and realized this bill did not do what it was intended to do. And this is right on the House Services Financial Services Committee's website on the government. They believe that this was a mistake. So we've pushed 18% of all depositors and checking account users out of the banking industry completely, right? So a lot of the young folks today don't have traditional bank accounts. Why? Because they don't offer really free accounts anymore because of this legislation. It was my estimate, and I don't have the reference, so forgive me if my number's off here, but this is my estimate. I do believe the number was $87 per account in additional compliance costs was what came out of this to the banking industry. So in other words, can they give you a free checking account if they have to now add $87 in compliance costs for that checking?
No, they've got to take that from you
So
to cover it.
what they've done is they've increased the fees that are not on the checking account, or they just charge you for checking $5 a month or what have you, or they don't pay you interest like they used to pay interest on checking accounts. Very few do, right? So they had to get that money from somewhere. And unfortunately, they've hurt the worst people that need to be in the banking industry, that need to establish credit, that need to have regular lines of credit or regular banking facilities, checkbooks, et cetera. So we have a big quadrant of our society today that doesn't even operate with a checking account.
Well, and doesn't it also hurt the smaller community banks as well? They don't have they can't absorb this kind of a blow
Correct, and
like
so
the
we
huge
saw
ones
we
can.
saw the big banks grow exponentially, and unfortunately, that's what I'm saying. That's what you're going to see come out of this again. Is now they're going to try and put more regulation out there, and it's going to drive a wedge between the small operator in the banking industry. And like I said, I have a friend that owns a local bank here. Small family-run bank for 3 generations plus, conservative run. But people will run scared because of what they hear on the news and the media, and so this is really benefiting, unfortunately, the big four. So, and that's Citigroup, Wells Fargo, Bank of America, and Chase Bank, which is owned by J.P. Morgan. Those are the big four behemoths, around 3 trillion plus in assets each, and they're going to be the net benefactors of this. And again, this is the pay to play rules. So Barney Frank, you brought it up, right? He was on the board of Signature Bank, one of the banks that went down 2 weeks ago, right? Well, so he started lobbying Congress to release the regulations, reduce them, make it easier for these guys to compete. Why? Well, someone asked him. He goes, "Well, I got to get paid somehow. I'm retired, right?" So I mean, he just flat out said, "Hey, they're paying me to do this, so I'm gonna tell you everything I told you before was a lie."
He did a 180, a
Yeah,
180
yeah.
degree switch.
So,
Yeah,
but
yeah.
unfortunately, politicians are politicians, right? We know this, and so they're going to do what it benefits them. Unfortunately, in my opinion, again. But the bottom line, Chip, is this is going to harm the consumer because it's going to cost you more to operate a traditional banking account, savings account. I mean, I grew up. Do you remember passbook savings accounts?
Sure.
You had the little passport.
Yeah.
You'd write in your $25 deposit gift for your birthday, and
Mhm.
you'd earn real interest, and there was no cost, and you'd watch that money grow, and you were taught the power of compounding. That's gone, right? Today,
Yeah.
you open a checking account, and I can tell you from my own kids who are in their 20s, right? They open a checking account, they overdraft because they don't understand how to run their checking account. Next thing you know, they're paying these stupid fees, and I'm like, how do
Yeah.
you not know your balance in today's world with an app on your phone, for goodness sake? And but
Yeah.
again, this is going to lead to more expense and more cost for the average consumer.
Finally, David, the Oracle of Omaha, Uncle Warren may be getting involved here. Fox Business headline: Warren Buffett talks banking crisis with Biden team. Now, he has done this before, but as you noted, for a price.
Oh yeah, Warren doesn't take a shoddy deal, right? And he's very sharp. And he was recently quoted, and I loved it. Was I love a Sunday night call. I know the person on the end of that line is pretty desperate when they call me about 8 p.m. on Sunday night needing to get some cash to shore something up maybe by open of Monday. And he did a pretty good deal with Goldman Sachs, by the way, back when all the Lehman
Yeah.
Brothers and the Bear Stearns stuff, and basically got himself a great preferred stock deal with a guaranteed dividend and some pretty good upside. That was a pretty good investment. And so I can't blame him. He's got the capital, right? He's sitting on a hoard of cash right now, and he's got billions and billions of dollars. I mean, they always have, I think, around 20 or 25 billion, whatever their bottom line numbers. I think they have well over 4 times that today of cash ready to go. He's been investing heavily. I think we briefly talked about that in one oil company in particular, Occidental Oil. He sees something there, obviously. There was a couple articles this week saying, hey, you might want to follow suit. Again, we don't make recommendations on this show, so we don't think we're doing that. But Warren will probably help somebody backstop a bank, but believe me, it will be good to the shareholders of Berkshire Hathaway if he does it. He will do it in a way that is beneficial. So when you're desperate, somebody's got the cash, they back you in the corner, make you sign a deal maybe you otherwise wouldn't have signed. So people need to just be taking heed. If you're nervous about banking industry, learn the rules and take action. Don't just sit on your hands.
And make sure you've got strategies for every scenario. That's what we do for you here at Retire Smart. That's why if you haven't done so already, take advantage of the free report card, complimentary report card. No charge, no obligation. 402-369-7777. We'll look at your whole financial situation, and maybe you're in good shape. Maybe, especially the way things are going now, you need to make a few changes. Now's the time to find out. 402-369-7777 for a complimentary report card. Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, the first question is about prospects for 2023. This is on a lot of people's minds. We're just finishing up now the questions from our State of the Market event a few weeks ago. The question is, will my portfolio produce a positive return in 2023, or am I looking at another negative year?
Well, so far the markets are up, not very much, but they are up to start basically the first quarter of the year. We do believe there is some downside coming. But at our beginning of the year, at our state of the market, we talked about how we thought we would end up with a positive finish to the end of the year. So the markets typically, have ebb and flow. They draw down more than 10% almost every other year. We go down 5% almost every year at some point in the year. We've yet to do that this year. And so I do believe there's optimism where we can end up with a positive year, but it doesn't mean there could be a lot of volatility or carnage between now and then. We are, for our clients, currently pretty defensively stanced, if you will, with the intention that we believe that the odds of going lower, at least in the coming months, are greater than the odds of going significantly higher at this juncture in time. And of course, that opinion is subject to change as the data comes in. But you know, if you're investing, you should not try to time or look at things like, well, how am I going to do in the next 6 months or in the next year, right? Dollars within the market should be dollars that are not needed for 3 to 5 years at a minimum, at least in my opinion. And so when we kind of explain this to our clients, how we design our portfolios for income flow, et cetera, we have dollars on the sidelines for those that need access to them in either hedged or principal protected accounts. There's things we can do to mitigate risk and loss. And that's what we do consistently across the board with our clients, is understanding most clients are taking more risk than they probably feel comfortable taking, Chip. And that's one of the reasons why we offer a risk analysis.
Well, I'm reminded of a story, David, when I first came to work at Retire Smart during the pandemic, and we can't use names, and I'm not going to use the exact numbers. I don't even know the exact numbers. I don't work the numbers side of this business, but I remember the story. Somebody called you, and the client said, I've been dreading this. I've been making, for 3 weeks. I've picked up the phone and put it down, picked it up, put it down, but I finally decided I got to call, I got to ask because markets are dropping 20, 30, 40%. Okay, David, give me the bad news. He said, well, let me go check. And this person's portfolio was down something like 6%. It was a single digit number, and he was ecstatic. He was thrilled because part of the game is to mitigate damage in the rough times so that when we get through it and the upsurge happens, you've got as big a pile of money as possible to take advantage of the inevitable upswing that's going to come.
Well, yeah, and you've got to stay invested. You can't just, stick it under the mattress. I joke about all the time Melissa's mattress money plan. You can't just put it all in cash and think you're going to survive when we're running 6+% inflation, when taxation issues are going higher and higher. You're losing spending power to taxes and inflation. What we try to do is help clients understand how to get on a realistically time frame, right? A long-term portfolio, how to consistently beat those two things. And that's how you get what we believe achieving what's called a real rate of return. In other words, beating taxes and inflation consistently. But there's going to be times, quarters, months, even years that can't be accomplished or is not going to be accomplished because no one's got the perfect crystal ball, and it's just reality. So, you have to understand exactly that. I do remember the call too. I remember who you're talking about and that day, because the markets were down around 25%. This was just in the beginning of COVID and was really wigged out, and we had already taken proactive action and kind of explained to them how the dollars were allocated, and that was a pretty good call. And that we had it was pleasantly surprised in reviews that year when clients understood how we do what we do, and they were like, okay, this is pretty cool. So again, you should set up your portfolio with your professional advisor in a way that makes you comfortable. If you're not sleeping at night, you're probably in the wrong stuff. I mean, plain and
You
simple.
you just mentioned beating inflation, David, and the next question is about cash versus inflation. What are some safe alternatives for cash right now as a hedge for inflation?
So, as a hedge for inflation, not to literally beat it in the moment, but to hedge it, we mentioned earlier, treasury management right now, you can put dollars in UST bills and earn north of 4%. And there's different maturities. You can do 4 weeks, 8 weeks, 13 weeks, and these come out every week, new ones. And the interest rates will ebb and flow a little bit. But earning 4% and the benefit of treasuries over like a savings account or a CD at a local bank is that CD, both of those you pay income tax on the interest, Chip. But when you buy T bills, you're exempt. That interest is exempt from state income tax. And here in Nebraska, that's 6.84 for most of our clients. So that effectively enhances the yield a bit, right? So you get an actual higher net yield on those dollars. Now, it's not going to, with inflation at 6 still, right? That's not going to take care of it 100%, but it's certainly going to help hedge, which is what the question asked. Now, the other things that you can do is understand is long-term assets that do well against inflation are things like real estate. We talk about all the time, one of my favorite investments. Real estate typically goes with inflation. Now, there's going to be times where it goes backwards, and I think this could be one of those years. So I'm not saying go out and buy a bunch of real estate right now, but you have to understand how to allocate your dollars in a way. And Chip, when we do some of the workshops we do, you've seen me do it. I talk about there's three attributes when you're investing money. You need to understand all three. Number one is we all want to grow our money, growth is being the first attribute. But to do it, some of us are willing to take more risk than others. So the second attribute is safety. How safe is your dollars? So if you put it in real estate, I say that's relatively safe because it doubles in value about every 18 years or so, sometimes faster, sometimes slower. But it's relatively safe. Now, what it's not is the third attribute. And that
Liquid.
liquid. It's not liquidity. And if you were to sell that asset, typically you're going to have a lot of closing costs or commissions to a realtor. So it might be 10% or more in total expense to sell that asset. So there's a trade-off. Now, if you want to have pure liquid assets and have growth, well, you can invest in stocks, and stocks typically outpace inflation. However, are they always safe? No. So you can get two of those three really in just about anything. And like you can stick your money in a savings account right now and feel safe, and it's liquid every day. And same thing with those T-bills. But is it really going to grow and outpace inflation? Not
No.
in the current environment. So that's what we do as fiduciaries, help clients understand there are different reasons to have your dollars allocated in different areas. And then what we do, I think better than anybody else, in my opinion, is we then layer a tax allocation on top of that and show you how to allocate your assets versus the tax code. So in other words, I think you should own real estate in what we call a taxable account, right? Because there's so many tax advantages. Why own real estate inside an IRA? And we have lots of clients that do these things. And so understanding how all this works is really, really important.
Next question, David, is about international investment. It looks like valuations and growth potential are better internationally. Any plans to take advantage of that?
Absolutely. And we actually, in one of our strategic models not that long ago, put a toe in the water, so to speak, over in China, because we believe China is the only developed country in the world right now that has had loose monetary policy since the start of this year. Now, the U.S. just increased their balance sheet by $500 billion. That's another story. But we've been in a tightening mode. We've been raising interest rates. Europe just raised interest rates again, and that's creating havoc in those economies. There will be a great opportunity in Europe, by the way, and according to some of the big box retailers, Vanguard, BlackRock, et cetera, they believe Europe will actually have a better rate of return, slightly better than U.S. equities over the next decade. Now, that's their view today. We just don't think the timing is necessarily ripe to jump in with both feet on those. But absolutely, international allocations are important. We used them pretty consistently. It was when we had Trump's tax cuts pass, 5.5 years ago or so. That's when we kind of went solely to a U.S. based allocation for a while because all the money was flowing back to the U.S. on the tax deal that corporations were getting, and so it just made sense to have the money invested here. But absolutely, there'll be opportunity internationally, China and Europe as well.
Well, speaking of China, now does that calculation change if things heat up
Absolutely it
regarding
would.
Taiwan?
Absolutely
Yeah,
it would. And that's why I said it. All we've done thus far is put a little toe in the water, so to speak,
yeah.
because we're not ready to jump in there. But again, no one knows the future. Anyone that says they do is crazy in my opinion. But we can take data and take the best probability forward in our humble opinion of where we think we should allocate dollars. And again, our clients are not asking us to try and make 35% a year. That's not the goal. The goal is to give them a real rate of return, consistent rate of return, and help them have dollars available when they choose to spend it and mitigate taxes, et cetera. And that's part of our proprietary smart planning process.
Well, speaking of that proprietary smart planning process, it's also why you monitor political events as well as economic events, and of course, often the two are linked. Because people have said, "Boy, you guys talk a lot of politics on your show." Well, that can directly affect people's portfolios.
Well, absolutely. We just talked about earlier the legislation Dodd-Frank that had major implications for banking stocks, et cetera. And there's probably more legislation coming out, and it'll get bipartisan support because it's good to go back and tell the consumer, we're protecting you, we're protecting you. And the reality is, I don't think they really are, and they're just making it harder to access capital and credit and just basic banking facilities that used to be, Chip, before Dodd-Frank, 75% of all checking accounts in America were free. That number was less than half just 2 years later. In just 2 years after that bill was passed, the consumer had to take it on the chin. And that is not helping the consumer or the economy long term.
Do yourself a favor, get the complimentary report card, 402-369-7777. Whatever the economy or political events may deal you, we have strategies to address various scenarios. 402-369-7777 for your complimentary report card. Up next, should you be a renter instead of a homeowner in retirement? Conventional wisdom says no. Is conventional wisdom right? Stay tuned to find out. You're listening to Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, I saw this and I wanted to get your take on it because I know conventional wisdom is, well, one good thing about being retired, you've paid off that home and live in that home and enjoy the equity you've built up. But I saw this headline from Nerd Wallet. Should you rent in retirement? Uh, Obviously, the article said, well, in some cases, maybe it makes sense. David, I wanted to get your take on that.
Oh, I think it absolutely can make sense for a lot of folks. So there's obviously the old adage that if you had a mortgage, you paid your house off, you feel like, oh, it's mine. Well,
Yeah.
if you're paying property tax in Nebraska, you probably think, okay, maybe it's not mine. I can tell you my monthly property tax bill. If I took it out, I just pay it each year. But if I paid it monthly, that's more than my first mortgage.
Yeah.
The first home I bought my wife, 28 years ago, and so. Do I really own my home? I don't feel like I do. I will tell you, though, for a lot of people, it does not make any fiscal sense. Now, some people rent because they have to. They don't have credit or the assets to purchase a home. But even those that do, sometimes it absolutely can be a good deal to rent where you're going to spend retirement. So here's a couple of different reasons, Chip. So number one, as we age, we're going to need different assistance, and sometimes mobility becomes a problem. And the article, I think, references some of this stuff.
It does.
Where in other words, you may need, like my dad uses a walker. He doesn't use a wheelchair, but he actually has to use a walker. And so steps are a problem, right? And so when you live in your house, sometimes, and it's real popular around here, people want to downsize, but here in Omaha, typically you're downsizing out of a 2-story with maybe a walkout basement to a ranch style house. And on average, it's about $100,000 more to do that. And they're like, wait a minute, we're giving up half our square footage, right? So economically, it may make sense to rent in retirement in some communities. Plus, you also have true mobility. In other words, well, what if you wanted to live in Florida or Arizona for a year or two, but then kind of come back home? You could sell your house. You could put it into something like treasuries or CDs right now and earn 4 or 5% on that money while you wait for the next year or two, and you're renting or something, and then you come back and maybe be able to buy something different, so or smaller or whatever it is that you're looking for.
Flexibility.
Yeah, and
Yeah.
you have flexibility, and you can move around. There's so many different reasons, but the other reason is if interest rates continue to stay high like they are, and you can get a fixed income to start paying you north of 6-7% without a lot of risk on those investments. Well, think about that. If you sold your house for say $400,000 today, that's 28 grand a year if you were getting 7% on that investment, right? So if there were safe bonds out there, and there aren't today, but if that happened, if interest rates stay high like this, that will come back around. Well, what could you go rent for that $28,000 and still have your 400 grand principal safe and sound, protected, by treasuries or U.S. government bonds, et cetera? And then, after 5 years of that, okay, we want to buy something. But then the other facilities you got to look at is these community care homes they have, where it's kind of step up. You buy equity into them. My dad actually looked at one of these in Valley Forge, Pennsylvania. It was really nice, a beautiful high rise, and basically you buy. And the last time we looked, it was a couple years ago. It was somewhere between 250 and 300,000 was your buy-in for your unit, and then you pay monthly, sort of like you would with some kind of assisted living facility. And there's the base level care where you just need somebody to come by and check on you. Then there's assisted living care, and then there's full blown nursing care. So they
Step it up as you need it.
Step it up as you need it. But when you ultimately pass, your family gets the equity, and the value of those units goes up. So your
Sure.
family still gets the what you invested in, and typically more, because inflation drives the value of that condo, if you will,
Yeah,
up.
that
And so
sounds
these have
great.
become really popular for those that have assets. And of course, if you don't like it, you can just sell it and move on to something else. And the other big benefit of renting in even an apartment community, and we have several clients that do that right here, is community, right? You don't
The
want to be
article
isolated.
mentions that, and we see that come up so often in retirement planning.
Well, what did we talk about?
Yeah.
Happiness is the one thing that a lot of retirees a
Yes,
couple weeks
right.
ago
The
are
Harvard
missing.
study
Yeah,
on
the Harvard study.
happiness.
And
Yeah.
it's because people unfortunately feel isolated. I know my mom and dad right now live together in South Carolina, and I get a text about every 4 days. When are you coming to visit? When are you coming to visit? And
Yeah.
I try to get down there at least 3 or 4 times a year, and that's not enough right now. And I get it, because he feels a little isolated. He's not as mobile as he once was. He's helping care for my mom, who's got, unfortunately, some some dementia stuff setting. And so this is the reality, right? So having a sense of community and some kind of community can really help somebody's spirits be lifted. And what is that worth, right? So there's lots of reasons, and not just
Yeah.
economic ones, where it can certainly make sense. But again, this is why you should work with someone who's retirement specific in planning, Chip. This is who we deal with every day. We're not typically working with a 32-year-old who's trying to buy tech stocks. That's not what we do here. Nothing wrong with that, right? But what our model is to do true holistic planning and cover all the areas and all the factors, as you always say, that affect a good retirement. And this is decision making 101. Like, should I live in this type of city? Should I rent? Should I consider being a snowbird? I just did a review of a client who's going to be retiring. And I gave him the good news. Those are always fun meetings. He's like, I was planning on working, I know, another year and a half, but I'm thinking about stopping right here June 1 because my kids are out of school and my wife and I they've been living apart. They've been living in 2 states because the job he took. And I gave him the green light. I said, but don't make the decision today. Go home, think about it, pray about it, do your due diligence. He took about a week and emailed in. All right, I just put my notice in. June 1, I'll need some of that income you
Wow.
talked about.
Yeah.
So we've set up his plan. We let him know he's good to go. But now they're consolidating households, et cetera, and they're going to rent because they're going to be living in Texas, this particular individual, and they're going to rent for the first 2 years just to make sure that's really where they want to be forever, and then they'll buy a house similar. I had another,
Again, the
yeah.
flexibility.
Well, I
Yeah.
had another
Mhm.
client retired out of Connecticut a couple years ago, moved down to the Myrtle Beach area, South Carolina, and rented the last 2 years, and now they are making a purchase. And nope, we love it here. This is definitely where we want to be, and now they're buying a home. And exactly, we just safely managed in treasuries the capital that was from the sale of their home a couple years ago. There's lots of options available, but you have to have somebody who can help walk you through this, talk you through this, so that you're making the decision you really want. What is the outcome you desire? I say this all the time. I just helped 2 different business owners this week with exit strategies. And one wants the capital for them now, and the other one just wants the money to go to grandkids. Totally different planning ideas and ways to mitigate taxation and help get the maximum value of the business, et cetera. But this is what I love doing. This is fun to do. So again, don't be shy out there. If you're not sure that your guy or gal or whoever's helping you is giving you this time of holistic advice, you might be a candidate for what we call the report card, where we go over the 5 areas of our proprietary smart planning process and help you understand what that looks like.
David, I got a CNBC headline here. After an 8.7% Social Security cost of living adjustment for 2023, next year's increase may not be as large. Well, it couldn't be. I mean, you can't sustain that year after year, that kind of increase. So I guess the question is, have you planned for it, folks?
Right.
David, what are we doing here at Retire Smart to
So,
help people handle
well,
this?
when we plan out the future, we just use historical numbers because that's the safest way, in our opinion, to do it. And so, since inception, it's been between 2.4 and 2.8% average, since we've started giving COLA adjustments to Social Security over the last 70 years or so. And the last 2 years have been really high because of inflation rampant. So we've gotten over 14.5% increases through those 2 years. What we want people to do is not get spoiled or expect that exactly, Chip. We're still going to have probably a 4.5 to 5.5% increase coming at the end of this year. You need to remember the fiscal numbers the government runs on end mid-year, so they do their fiscal year ends in the middle of the year, basically. So we'll see how far inflation drops and then what the COLA adjustment will be. If we calculated it today, it would probably be in the neighborhood of 5.7 to 6.3 still would be the increase. But again, I think they'll trim that down a bit before they give it. You got to remember too, there's real big incentive in the government actuarial offices to suppress what inflation is because of these payments, right? That's more spending by the government. The Social Security bill alone has gone up 15% in the last 2 years, and then new enrollees, about 10,000 a day, are adding on to that. So again, you want to make sure someone's helping you make those decisions, and that's where Sean Swanson runs that Social Security Blueprint class, so people can understand what that looks like. Because folks, you still get those bumps even if you haven't drawn yet. So don't think you're not participating in that. Your estimated payment goes up by that COLA as well.
I'm only going to give you a minute for this one, David, but I want to hit it because you sent this to me, and wow, this got my attention. Another CNBC headline: investing isn't free, but here's why 20% of investors think it is. Clear up the misconceptions for us, David.
Well, and those inside the article, those that are under a certain age, it was like 37% believe they paid nothing to invest dollars. Folks, that's impossible, right? You're kidding yourself if you think it's free. Every business that's in business for profit must make a profit. And so there's these large institutions. Now, this is interesting too, because there's these large, big institutions, and TD Ameritrade, Charles Schwab, Fidelity, Vanguard, BlackRock, that let you invest with them. And people are like, oh, it's commission free. No, it's not. They're
Yeah.
stripping money out of basically the money market accounts to make money there, basically. So they pay you nothing on something that's paying them 3 or 4% now. So they're actually making huge margins. And with the deposit destruction going on in banks across the country, that could harm some of these guys. That business model might be under threat. And so if the idea that you think you're always going to be free in your vesting, it's just not real. And a lot of people invest in mutual funds think there's no cost. There's myriad of costs, expense ratios, transaction fees, 12B1 fees. This is what part of our process, Chip, is to run a fee analysis for those that like us to do it. And that, again, is part of that proprietary smart planning process.
And it's completely transparent. There are no hidden surprises. Hey, look, now the tax planning guide is a good first step. But what you really want to do is take advantage of the report card, the comprehensive review, complimentary review of your financial situation. 402-369-7777. No charge, no obligation. 402-369-7777. David, bring us home.
Hey, Easter's coming up. If you haven't gone to a church in a long time, you're welcome to come to mine. Flatlands on 144th between Fort and Maple. Have a blessed week, everybody.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.